So we stopped here with Farmer Monica's economic loss, $52,000. Economic loss means earning less than the next best choice. Two choices. One is farming the land herself, which she would get $20,000. And the other choice, maybe this is option A. And the other choice, option B, is to work for someone else, rent the land out, leave the money in the bank, and get $72,000. It doesn't mean don't pick option A. It just means that Monica should be aware of the other choice and what she has given up. Now let's look at another term, economic profit. Here you're earning more than the next best choice. So let's increase the revenue now. It used to be 120. Let's say that Farmer Monica believes that she can get more than that now for whatever reason. The price of wheat is now higher maybe. Or she anticipates an increase in the price of wheat. So now let's look at Monica's economic profit. We keep the same cost here. Again, 100 of that, 100,000 of that is the explicit cost. 72,000 is the implicit cost. So now we take 200,000 minus 172, we get an economic profit of $28,000. That tells us one thing only, that Monica, this option here will bring $8,000 in the next best choice. If you look at the accounting profit, it would be 200,000 minus the explicit cost would be 100,000. Now that's the two choices. Instead of being 20,000, it's now 100,000. So now we have two choices. A, work the land herself. B, rent it out, work for someone else. Now this one's higher by how much? 28,000. So it tells us another option out there, option A this time, where Monica can earn $20,000 more than option B. Look at one more possibility, what's called normal profit. And this means you're earning the same as the next best choice. They're equal. So let's make the total revenue $172,000. Why did I pick that number? Because it's exactly equal to the economic cost. So the economic profit minus economic cost is zero. Now that's zero economic profit, not accounting profit. There's a big difference. A lot of students have trouble with the concept of zero profit. They think you're just barely getting by. No, zero economic profit means you're doing well. You're paying all of your explicit cost, plus you're getting enough money to cover what you could make somewhere else. Look at the accounting profit. $172,000 of revenue minus the cost, explicit cost of $100,000 leaves us with $72,000 accounting profit. So zero economic profit means a very large accounting profit. Now the options are the same. Option A now is $72,000. Option B is $72,000. They're the same. There's no difference. So zero economic profit is telling us one thing and one thing only. You are making as much money here, accounting profit-wise, that you can make in your next best choice. So zero economic profit is okay. It means you're covering all of your expenses, your payments of bills, and you're also getting a return equal to what you can make in the other option. So you are earning normal profit. If we say you have zero economic profit, it means you're earning normal profit. You're getting the norm. You're getting what you can make somewhere else. So what these profit numbers tell us as economists is where resources are going to be flowing. So if you have an economic loss, that means that you have a better choice somewhere else. Resources will leave. So resources will leave these kind of markets as the owners move into the other choice where they can make more money. If you have an economic profit, then resources will come in. Resources enter. And that's good. What the markets are saying is that they don't want as much of this stuff here. And with the economic profit, they're saying we want more here. And so resources will flow in this direction. And normal profit will be sort of an equilibrium. No reason for resources to leave or enter because you cannot make any more money anywhere else. And therefore, no reason to leave what you're doing. And this actually would be sort of a long run condition for very competitive markets, which if you look at very competitive markets, after all the dust is cleared and resources are flowed in and out, these kind of markets will all be earning normal profit. The last thing to do in this lecture is to look at time periods. We looked at we looked at this when we looked at the elasticity of supply. So we have market period where again you have no time to change anything. Your quantity supplied is fixed. So there's really no decision for the firm. And this would be when your supply is vertical. Now, two time periods when you do have decisions to make. One is the short run, one is the long run. And they're not defined by calendar time, by months, weeks, years. They're defined by how long it takes for you to change all of your resources. When you look at a business, you have to make day-to-day decisions about your business. That would be what economists would call the short run. A short run, the technical definition of the short run is a period of time in which at least one input is fixed. We normally look at that as being capital. So if you look at a restaurant, the short run for a restaurant would be when they're making decisions where the size of the restaurant is fixed, the oven size is fixed, the number of tables in the dining area is fixed, the parking lot is fixed. So you can't change the physical attributes of the business, but you can change some things. You can change your staffing. You can change the number of people coming in, maybe leaving early if business is slow. You have to worry about ordering food. You have to pay the fuel bills, the utilities. You have to make sure the parking lot is clean, make sure the restrooms are clean. Those are the kind of things you have to worry about in the short run. The time period is too short for firms to be able to expand or contract their capacity. So the size of the restaurant is fixed. Well, plant size would be more of a manufacturing term, but it could be the size of your office, the size of a dental office, the size of a gas station. All that is fixed in the short run. You also don't have enough time to leave this market or enter a new one. So pretty much your decisions are how do you run the current business as best you can. The long run is more of a planning period. This is when you can change everything. So it's a period of time in which all inputs can vary. There are no fixed inputs. The firm capacity is able to vary, and firms are able to leave and enter markets. So this is where you have, say you own a business, a restaurant, and you have to worry about day-to-day operations. But then when business is slow, or you're closed for the night, or maybe you don't open on Monday, you can think about where you want your business to be 5, 6, 7, 10 years from now. And so you have to maybe talk to some architects about changing the size of your restaurant, maybe open another restaurant across town. Maybe the business in the restaurant is not that good, and maybe you want to sell off your assets and go somewhere else. Those are your long-run decisions. Do you want to expand? Do you want to contract? Do you want to leave this market, enter a new market? Those are your long-run decisions. Your short-run decisions on how do you run your business day-to-day right now with the current size, the current capacity of your business. And we'll stop there.